All right, good afternoon. This is Chris with Mustang Stocks. It's 4 p.m. Japan time, and so just a couple hours away from the pre-market. It is the 13th of January, so still looking at that January 15th week. And coming up on Thursday, which is going to be a big day. Thursday is going to be the day that we all do the sell some puts, right? Selling puts, easy way to make money. It feels like cheating sometimes. It's that easy. Again, just to reiterate from some previous videos, selling puts is a win-win, right? You get a premium, or you get to buy 100 shares at a discounted price of a company that you want anyway. So why not? All right. As always, I'm not a financial expert. I do this for fun. I do this to teach people about stocks, teach people about things that I'm looking at for that week, upcoming, maybe some insight on some news or whatever the case may be. But do your own research. Look at look at stocks that you like, that you're interested in. Yeah. Today we're going to be looking at a chart for Plug. Plug has been going through the roof lately, and I got a little bit of a horror story with Plug. A few months ago, I was in Plug. I got in it real early when it was really cheap, and I had numerous conversations about it, and I was like, this is a $36 stock, and I was in it at like $12 or $16 or something real cheap. And doing, call options and everything like that, the normal stuff that I do. But I kept on saying this is a $36 stock. It's $36 stock. It's not really going to go anywhere above that. Damn it. I was wrong. It is currently at exactly $70. Would have been nice to have, 30, 40 grand invested in that when it was down at $16 and just held on to it. Yeah, you win some, you lose some, right? So, but are there things that you can still do with it at $70? Of course. The Plug has been in the news lately, picked up by Lucid, some deal or merger or whatever regarding use in their vehicles. So just watch the news. Plug deals with hydrogen power, and maybe that's the next best thing after like these EV type batteries. Who knows, right? But just keep an eye on it. So we'll go into an analysis on Plug and why I would not get into it. I have no intentions on getting into it right now, and why I will likely get into it later. It's at $70. Why would you get into it later? Because it's probably going to come back down. As any stock that increases the manner in which Plug is increasing, it's going to come back down. And if you don't believe me, go do your own research. Look at stocks that go up in the manner that this one has gone up, and you'll see exactly what I'm talking about. I talk a lot about EV. You look at NIO, XPeng, and Li. The very popular companies right now, very popular stocks, and all three of them did that just last month. You get this parabolic or exponential rise, and then all of a sudden it just drops out into significant consolidation. That's where we're at, and unfortunately we're so high with Plug right now to really know when it's going to drop and consolidate, and to what value is not really a known, and it's too much risk for me to take. So I won't do it. Now, how do you minimize that risk? Vertical spreads, right? I can do a week-long vertical spread and hardly take any risk at all, and minimize how many lots of that vertical spread I do, right? A lot of times, if I feel comfortable with a share price and I feel like it's really going to go up, I could do a vertical spread, which already drops the risk, but then just do more lots of that. So I'm just bringing the risk level up a little bit. And it's not so much that I'm bringing the risk up, because it doesn't matter if I have 1 lot, 10 lots, or 1,000 lots. I effectively have the same risk as I would that one lot, right? So the risk that you're adding is the fact that you are paying more for a premium, right? The more lots you have, the more money you're spending up front. Now, if you're virtually in a for sure thing, buying a couple extra lots doesn't really increase your risk at all. At least that's how I kind of view it. I look at what the risk is for 1 lot, and if it's very low, or I feel as if it's a very low risk, and quite a bit of reward, then I'll spend all my buying power to buy as many lots of that as I can. Because if you think about it, like if I get into a vertical spread that only cost me $30 per lot, with the chance or the opportunity to win $100, you're getting 3 to 1 plus on your investment. I mean, that's phenomenal, right? So now, if it's in a company that it's in the news and it's got some good volume, and it's everything points, all the indicators points, it's bullish, it's got bullish flags, and it's popping through lines of resistance. If it has all those indicators, the risk for 1 lot is going to be the same risk for 10 lots. Right? So if you feel that comfortable and that confident over that 1 share, do it for 10 if you can afford it. Because now I'm not looking at, $30 going into $100. I'm looking at $300 turning into $1,000, or $3,000 turning into $10,000. Right? Those $30 to $100 isn't going to be life changing, but $30,000 to $100,000 is huge. It's the difference between buying a brand new Honda Civic and buying a brand new home. So think about it, and you effectively have the same risk as if you bought 1 lot. All right. Okay, so let's get into it. Plug. All right, so looking at the 30-minute view, we'll go back a ways. And you can see how this has gone up. And just look at that rise. It makes that sound when it rises too. Let's go back to a day view. I mean, just look at that. This is what you want to see, all right? Just going up, some consolidation, going up, consolidation, going up, consolidation. But this is where I start to get worried. I mean, look at this. All this green volume. Plug hits the news, it starts doing a merger with Lucid and all this crap. And next thing you know, boom, it goes from 32.89 to 66.02. I mean, my goodness, that is a huge rise over a very short distance. And in fact, that's 100% nearly, almost 100% rise in less than 2 weeks. you know, less than 10 days. That's ridiculous. I mean, it would have been great to get in here and then sell here and walk away with some tremendous profits, but I didn't. I'm sure other people did. There's so many stocks to look at. It's hard to be perfect on every single one of them. You know what I mean? But like I said, is it too late to get in? Absolutely not. I can do a vertical spread, minimize my risk, take advantage if it does go up a couple more bucks. And if it drops, well, I minimize how much I lose. All right. I'm still taking a chance, still taking a gamble. So when do I get into it? Well, with this parabolic rise, like I said, there's going to be some cutback. All right. And with it going up from 30 to 60 or 35 to 70, that's a 100% rise. I would expect to see this probably come down 25%. All right. It's going to come down. Maybe here. All right. $47. Actually, you know what? I bet it comes down even further. I bet it comes down all the way to 37.15-ish, somewhere around here. Why? Because you got this gap. All right. You got a gap here. You got a small gap here that was kind of covered by a bottom candlestick, so that might be fine, but you don't have anything here. And that's huge. All right. So more than likely, this sucker is going to drop quite a bit, come back down, and then probably get back on this normal trend line that you can see. All right, you can see how this is a nice smooth trend all the way up, making a little bit of money. All right, this is the anomaly. All right, if you got in on it, awesome, congratulations, walk away with your profits now, because I would expect to see this drop quite a bit. All right, let's take this to 1 hour view. Yeah, it's quite a bit. MACD, overbought, lots of volume, but not normal volume, not what we've seen previously. All right. I mean, just look at this trend. If I were to throw a trend line in this view, from here to here, right? Goes from $22 to $37 over the course of past few months. That's great. That's what you really want to see. A nice slow, steady rise. Again, having this here, that's great too. If you caught that right here and took advantage, even if you just bought in here and then sold right here, that's awesome. Congratulations. What I'm getting at is if you're not in it and you're like, man, plug, I should get into it because it's making a whole bunch of money. I think now is too late. For now, I wouldn't get into it right now. I would wait till you see it come back down, and then I would get into it. In fact, this is one on my watch list. I'm putting it back on, and I'm going to start doing a lot more research because obviously I was wrong when I said this is the $36 stock and it's going to stay and consolidate at 36 for now in the next couple of years. But it very well could have potential in the future, and it could be very good for a long-term investment. But this trend line is realistic. This trend line is not. This is inflated due to news. This is inflated due to TikTok videos and Facebook articles and all this other stuff that you see. But if you actually go and do the research, this is realistic. This is what you would expect to see gains over so long. All right, about that. You got a parabolic rise here. Expect to see a very large drop, consolidation, and then a slow, relatively linear rise. And hopefully, it's more along the lines of up here. After it drops out, could definitely have a higher rise. Who knows? Again, it's just something that you want to watch. All right. So like I said, I'm not going to get into it. I probably will do some vertical spreads. Now, a lot of you ask, like, what is a vertical spread? All right. Well, with options, we talked about in previous videos, an option is based on 100 shares. All right. I say, let me bring this up. I got it already pre-staged. All right. So we look at a buy call option. All right. So it's currently at 70.45, and I pick a date that I want to go out to, and I say, okay, February 12th. Excuse me. Where do I think plug will be at February 12th? And I say, well, I think it's going to be, I don't know if this is something wrong with the internet or why those are not showing up. Let's see if something comes up on February 5th. Maybe there's just not a whole lot of, I can't believe that. Anyway, so I say, okay, by February 5th, I believe that it's going to be at least $74.93. I think it's going to be like, $80. So I pick this one because it's reasonable and it's a strike price of $65. So when I get this, as long as the share price is greater than $74.93 by February 5th, I'm going to make money. How? Because I'm basically saying that I have the right but not the obligation to buy 100 shares at $65. Now, I don't have to actually do that. I don't have to buy 100 shares at $65 because I can sell this option. Right? In order to get into this, it's going to cost me nearly $1,000. Right? So almost $10 per share times 100 shares, that's $1,000. Many of you probably can't get into this right now, or maybe you can only get into one or two lots, and you don't want to take that much of a risk because you don't know. So how can I minimize the risk that I have, right? And I think this might be, oh no, okay. So how can I minimize the risk? Well, you can minimize the risk by, instead of doing just a call option, I do a vertical spread. A vertical spread drastically lowers the premium that you're going to pay, but it also, unlike a call option, or when you buy a call where you have virtually an infinite possibility for profit, a vertical spread is going to cap how much you can make. And it's very easy to determine how much you're going to be able to make. You just look at the difference between the strike prices, right? So what you're going to do, and what I like to do, is I just take what's ever below, right below and right above your current share price. So I can buy a call here. Oop, I'm sorry, I gotta click this guy. All right, so I can buy this call, then click on sell, and sell this call. Right? So then you notice up here it changes and says call debit spread. So what does that mean? Well, everything that I just said. This minimizes how much I'm going to have to pay in premium, but it caps off the maximum. This one specifically is 41 cents. So this is going to cost me 41 cents per share. Times 100 shares, this cost me 41 bucks. Only 41 bucks. But I have the potential of making $100. 71 minus 70 is $1. Times 100 is $100. A $41 premium to win $100. And the price only has to go up from $70.45 to $71. Very minimal risk for a company that's been accelerating and on its way up. And worst case scenario, what if you do hit it when it does start to come back down and consolidate? You lose $41, right? Or you lose something less than $41, you know? So that's where a vertical spread really comes in. And the cool thing about a vertical spread as well is it takes the guesswork out of when to sell. All right. On other call options, you kind of have to think about, when do I want to sell? All right. Say I'm in right now, for example, I've got I'm investing in call options with Riot or ARK, right? So Riot, blockchain based on the price of Bitcoin. Bitcoin goes up, Riot goes up pretty much. All right. So, but what happens when Bitcoin goes down? Riot goes down. Well, Bitcoin is super, super, variable. So Bitcoin can go up and down $7,000 a day. So really, Riot can also change very drastically throughout the course of a day. So with that being said, I don't necessarily know the best time, or I have to really pay attention to the charts to determine when the right time to sell that call option might be, right? And a great example is just recently, I go from 1 week where the call option is up $1,000 per lot, and then the next week it drops so much that I'm only up like $100 per lot for the same thing. So it dropped $900 per lot. I mean, that's just a tremendous amount of money, right? Because, well, I made a poor choice. I should have sold the week before, but I held on thinking the price was going to go up. Well, vertical spreads kind of take that away from you, right? Because once you get above the strike price value, you can't make any more, right? Because as you're making money for this one, you're losing money for this one. Right, so you max out at $100. You pay $41, and you max out at $100. So your net profit is $59. Right. Well, 59 when you paid 41 is over 100%. You're still making 100%. Now, instead of doing one lot at 41, so this cost me 41 bucks. All right, put one. It's cost me 41 bucks to win 100. All right. So it cost me 41 to win 100. I go up $59. Or cost me 410 to go up 1,000 and I make 590. Cost me 4,100 to go up 10,000. I made 5,900. And then we start talking about some buco bucks. 41,000 to go up to 100,000, and I make 59,000, right? But this doesn't change. I still only have to go from 70-45 to 71. The only risk that I'm taking is that I'm putting more money into it, right? Well, that is a bit of risk, but if you're looking at an option, I'm not saying Plug is this way, but if you're looking at a company that you're almost for certain is going to go up, this might be the way to go. You can make some tremendous amount of money. And in fact, if you think about it, here you can turn 41 into 100, right? And then you can turn 100 into 200 and 200 into 400 and 400 into 800. Next thing you know, you're looking at, you just turned $100 into 1,600 bucks. You know? Is it going to work like that every single time? Yeah, probably not. Right? That's why you diversify and you do multiple different things. You buy some shares of a company, you do some call options, you sell some puts, you do some vertical spreads, maybe even throw some calendar spreads. You do it in various different companies, diversified, maybe even throw some ETFs that are already diversified, all of that. And every time you do that, you lower and lower and lower your risk. And then next thing you know, you're fully maxed out with your investing. You've got well over, $500,000 invested and making on average over $1,000 a day. You can't beat that, right? I tell you, when you have those days that you make 27 grand, increase your net worth by 3%. That's a great feeling, Now you just got to worry how you're going to pay the damn taxes. But that's a good problem to have, when you're worried about how you're going to pay taxes. Because even if you make $1 million and you have to pay 300 grand in taxes, you know what? You have 700 grand that you can play with. So that is a vertical spread. It's a great thing, in my opinion. It is a great thing for someone that does not have a whole lot of buying power, right? And even in this or in this portfolio, right? This is like my trying to turn $100 into $1 million portfolio. But even in something like that, like I think I showed you guys this not too long ago. And look where I'm already at. I think I showed it to you when I was like at maybe 12,000 or 18,000 or something like that. And now I'm up to, 24,000. I peaked at 25,000. But look at all this diversity. Look at all these things that I'm doing. I got Dropbox, call option for Dropbox, GHIV. This is a weird one that I messed up when I was doing. I wanted to do a vertical spread, but I messed up. I got some NEO things. Really, I did this just because I knew it was going up and I wanted to get a little bit extra buying power in this portfolio. But almost all of this came from vertical spreads. I mean, you can see here, a vertical spread. This is technically a vertical spread. Selling puts, vertical spread. Yeah. So, all of this is just diversified. It's diversity to lower my risk, right? Lower my risk, and yeah. Here's an example of a Tesla spread that I have. I have no idea how much I paid for this. I paid $976 for 4 lots. So it was roughly $240 a piece, probably to win 500, right? So yeah, the $5 spread. So the most I can win is 500, and I paid 244 in order to do that. All right, so I can come back and I can make 100%. I'm already at 66%. Right, so I'm almost there. All right, this ends on the 15th, and it's Tesla, so who knows? But I bet this goes up pretty damn close to 100%. It might not, 75, 80%, but I paid $1,000. All right, for 4 lots. You can do this and just do 1 lot at 244 and walk away with $500. Like, that's a great deal. Even if you just do this one time a week, you do this one time a week, spend $244, turn it into $500. That's $250, $300 per week times 52 weeks. That's extra money in your pocket. Can't complain about that. Start adding more lots, start adding different companies, more vertical spreads, minimize your risk. Next thing you know, you got $23,000 in your account. Take some of that, maybe roll it into a different account. Next thing you know, you got $1 million. $1 million it's a fun number to look at. All right, so that's all I have for you today. Hopefully that helped you guys out. If you do have any questions or comments, please leave them below. Like, subscribe. Remember, I'm not a financial expert. I'm here to, I don't know why I'm here. I'm here because it's fun. All right, it gives me a chance to, and honestly, this is all stuff that I do anyway. Now I'm just videoing it and sharing that with you. If you get anything from it, that's awesome. If you make a whole bunch of money, please leave that down here. Let me know your successes. Just leave the failures alone. I don't need to hear about them. I have enough of those myself. But leave me a story. Let me know how successful you were. I love to hear the stories, especially if I helped you out. That's definitely cool. If there's something you want to see, let me know. I'll throw it on here. I've done it already a few times. The other day I did a video for CLNE. Really hope that helped you out. If you want to see an analysis on a different company, please let me know. If you want to go really in depth and not just look at the chart, let me know. Let me know what you want. Leave any questions down below. Like I said, hit that like button, hit the subscribe. There's some Webull stuff down here. There's a Robinhood stuff down here. You get some free stocks, I get some free stocks. We all live happily ever after. But most importantly, make that money. I'm out.